Meet Karan Verma. He recently started investing. Karan is interested in investing in the restaurant business, so he decided to go with Spicy Ember, a restaurant located in his hometown. But before making the investment, Karan plans to compare Spicy Ember's performance with nearby competitors to ensure he's making the right choice. And also with top restaurant companies listed in the Indian stock market, such as Barback Nation, Pecos Pub, and specialty restaurants. While analyzing Spicy Ember's performance against its peers, Karan faced challenges because the competitors were using different depreciation methods, had varying debt structures, and operated under different tax rates, which makes him crazy. Let's help Karan by using EBITDA and EBITDA margin. In other words, earnings before interest, taxes, depreciation, and amortization, a metric that allows us to compare businesses on the basis of their core operating performance. To calculate EBITDA, we start with the net profit and then add back interest expenses, taxes, and non-cash charges like depreciation and amortization from the income statement. Now, let's use Spicy Ember Restaurant's income statement to calculate its EBITDA and see how it performs compared to others. Please note that all figures in the income statement are given in thousands. Let's plug all the relevant figures from the income statement into our EBITDA formula. The net income is 3,230T, income tax is 50T, interest expense is 20T, and depreciation is 1200T. After add back, our EBITDA is 4500T, in other words 45 lakhs. Now let's calculate the EBITDA margin. To do this, we divide EBITDA by the total sales or revenue of the company. The EBITDA is 4500T and total sales are 15,000T. So when we divide 4500T by 15,000T, we get an EBITDA margin of 30%. Now, with an EBITDA margin of 30%, Karan is in a strong position to compare Spicy Ember's operating performance with other restaurants in his city, companies listed on the Indian stock market, and even international players. Beyond performance comparison, Karan can also use EBITDA for valuation purposes. By applying industry enterprise value divided by EBITDA multiples, he can estimate how much Spicy Ember might be worth in the market. The enterprise value formula is market capitalization, adding preference stock, adding outstanding debt, and deducting cash and cash equivalent. Market capitalization is calculated by multiplying the current market price of a company's share by the total number of outstanding shares. It represents the total equity value of a company and is readily available for publicly listed companies. For restaurants that are unlisted and located in Karan's city, it's difficult to determine their exact market value. That's why we use listed restaurant companies, those traded on the stock exchange, as benchmarks for valuation. Now, we'll calculate the EBITDA multiple for each listed restaurant company by dividing their enterprise value by their EBITDA. Once we have the multiples, we'll take the average to use it as a benchmark for valuing Spicy Ember. Let's assume the average EV/EBITDA multiple of the listed restaurant companies is 15. This means that, on average, the market is willing to pay 15 times the current year's EBITDA for a restaurant business. To find the estimated value of Spicy Ember, we simply multiply its EBITDA of 4.5 crores by the industry average multiple of 15. That gives us 6.75 crores as the restaurant's estimated value. Don't worry about the valuation topic, we will cover it in more detail in our upcoming videos. Hence, EBITDA and EBITDA margin can be powerful tools not just for valuing a business, but also for comparing performance with peers, tracking internal efficiency over time, evaluating potential mergers and acquisitions, and much more. Whenever you are calculating EBITDA, it's best to take depreciation and amortization values from the cash flow statement, specifically under cash flow from operating activities. This is because sometimes companies include depreciation related to plant and machinery in their cost of goods sold or cost of revenue, which might not be directly visible in the income statement. To ensure you're using the complete depreciation and amortization figure, refer to the cash flow statement. And if it's not available there, check the notes to the balance sheet, specifically the fixed assets section. The notes will provide a detailed breakdown, helping you capture the full value accurately. That's all for today's video. If you found this helpful, show your support by clicking the subscribe button, and don't forget to press the bell icon to stay updated with the latest videos from RM Finance. See you in the next one.